Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome back to the show, Bob.
Yeah, Jim, good to be with you.
The equity markets had a bumpy road this week.
Well, yes, but the trend is still up, and if you're long, the trend is still your friend. But, and I've been saying this on each of the big surges, like the one up to June and then the one into September, and on each of these surges in the equity markets, the technicals, of which our work is as good as any, get highly overdone. Then there's a down to sideways correction, and this, of course, happened after September into, well, I guess it was our October 4th edition when we realized that, hey, the seasonal hit wasn't happening, and concluded and wrote that even the Dow Jones Industrial Average could get bubbled. And indeed it has. So we're now up here, and then, going back to last summer, August, on the decline then on the NASDAQ index, it generated what we call a springboard buy. That model is designed to catch corrections within a rising or flat long-term trend. So it's the buy the dip model, and a couple of weeks ago, it did it again on the NASDAQ. So, and then you take a look, as this old researcher does, and at valuations, and the one I like is the relative to the average wage in the States. So it's the amount of hours you got to work in order to buy a unit of S&P, and it's considerably higher than at the peak in 2007. I think the numbers are kind of like 118. 2007 was 98. And in 2000, which was the dot-com bubble, it got up to, I don't know, let's say 108 or something. So, but anyways, it's materially higher than in the mania of 2000. So you have a regard for that, a lot of commitment to the momentum and the trend in this market, but underneath it all, our indicators are saying, well, you get these corrections and you get a springboard buy, and the market moves on. So how long this can go, I don't know. But definitely we were looking for, that early October view that the Dow could bubble, and it included a line that when you get a bubble going, they go until they quit. And then noted some previous huge speculations that quit at the turn of the year. You had the Nikkei market, which that speculation in 89 was phenomenal, and it quit on the last day of 89. And then you had in 1973, the Dow reached its peak, I think it was January 11, and then the worst bear market since the 30s followed. And then, of course, you had the really big, huge, straight-up one, which was gold and silver, and that completed in, I think, January 22nd of 1980. And to give you an idea on that one, from November to, it was trading around in the 400s. And then by the time you got to middle of January, it was at 800, 850, I think was the high. So the Bitcoins are doing something like that. And it is certainly, it's not driving speculation in the broader equity markets, but it is part of a great speculation, and it is the one at the moment that has the biggest action, the biggest price changes. It's absolutely incredible. So who knows on this one? Our technical work on that one, the model we call it, gives upside exhaustions. Every once in a while, the spike in Bitcoin gets so hot that it does generate one of those. And sometimes the correction may only be a day and a half. And then boom.
Or maybe an hour.
In hours, yes. So this one is for the record. You've got, even all the way back to tulip bulbs in 1637, where you had remarkable price gains, as noted at the time. And I did see a chart the other day of somebody had created a price index for tulips in 1637, but I would not use it. I wouldn't even attempt to try and put together a price index because the references are so vague, and the markets were called in taverns with chalkboards and stuff like that. And
yeah, so can you imagine if they had the internet back then?
It would have been recorded. But anyways, authorities in 1637, let's see, that was Amsterdam was the world's financial and commercial capital, and they had authorities looking after markets, and they did warn that these transactions were outside of the system, and you had no recourse in case something went wrong. And of course, it did go wrong. But here, these transactions they're now getting onto the boards of the exchanges with ETFs, but I think the transactions are protected, and it's a new thing. And in interviews with other people who are really focused on the Bitcoin thing, the view I've had all the way through is not so much on the price of what this Bitcoin can get to. It is that at some point the public will insist on a unit of currency that the central bankers and their intellectual economists can't corrupt. We should understand that the today's central banking is totally corrupted. It's essentially helping to fund an experiment in unlimited government. And now the public, with the uprising, I call it the popular uprising in the States, it's an attempt to get the public's hands on government again, government by the people. Of course, the establishment is really pissed about this, doesn't like it, so resisting. But so that's one side of it, is to regain control of the government by the people. And the other part, which is not widely discussed, will eventually be that the people are going to have to get control of what money is. And I believe that all this stuff with the Bitcoins will eventually end up providing money that governments cannot corrupt. And it will be a great benefit to society. And I can say, Jim, it's getting there in a very exciting way with all these incredible price moves. So, but the end result will be very constructive for the financial markets.
We'll have more with Bob Hoye right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com. Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Ridout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
Welcome back. We're chatting with Bob Hoye. Bob, gold and silver just seem to be sitting in one spot, churning away. Is it going to break out one way or the other?
Oh, eventually, but this then has, and I don't see writers that cover the precious metals onto this at all, and that is that we are in a great financial mania. So, and I did this decades ago, is looked at you took the price of gold and deflated it by the CPI, and decades ago the calculation of the CPI was reasonable. And did it annually beginning in 1700. It was a lot of work. And then you notice the pattern on every great financial mania, like the first one was the South Sea Bubble in 1720. And then, of course, you had the price of gold and annual averages, and it would go down with the bubble, and then up as the crash came in. But each of these great bubbles were followed by a long period of contraction, whereby the excesses of one generation were gradually written off and corrected by the next generation of players. So then you would have a long credit contraction with a long increase in gold's real price. And the mining industry may not be sitting down doing the calculations, but if gold's real price is going up, then what's happening is you're getting your costs of mining are in control, are relatively benign or good or improving. So anyways, every great post-bubble contraction has had a long, and with it is a period when the real price of gold goes up and gold mining becomes the best game in town, and eventually you have a huge speculative market. So here we have now, if you take the real price of gold and it corrected, went down with the 2000 bubble, then it started to go up, which was proper according to history. And then you get into 2007 bubble, and it just did a modest correction, so there was something more powerful going on, that one. And it continued right on up to 2011, and hey, that was a 10-year bull market in the real price, and also for the gold and silver mining stocks. It became a fabulous game. But we'd noticed some time ago that on any rally for precious metals, you would have silver outperforming gold, but in anticipation of the reversal, silver begins to underperform gold. But what we did is we took the relative strength index on the silver-gold ratio, and in 2011 it got up to 92 on the daily, which is the only time it had been that high was in January of 1980 at that peak of speculation for gold and silver. So the 2011 high was a significant high. We wrote it up at the time and called the action dangerous and all that sort of stuff. And then there was another test. What was that? 2011, 2013, I guess it was, when the big rebound, no, that was 2012, September. Big rebound came in, and that then got up to an RSI of 84. Anything above 78 is dangerous. So there were good signals on the rallies on this thing on the way down. And here we are. So number one, Jim, precious metals are weak, relatively speaking, when you're in a financial mania, which we are. And the financial mania will end at some time. They exhaust themselves, and then that would see the gold's real price starting up very powerfully and on perhaps a long move, which would then make the gold mining sector, the great game in town. But it's going to be difficult. So this is where we've all written that we have a couple of comfort indexes for being positioned in gold or silver stocks, and one of them is the what's happening with gold stocks relative to gold. And if the gold stocks are outperforming gold, hey, that's a positive. But this has not been happening. The other one is that for a bull market in the metals, you want to have silver outperforming gold, and that is not happening. So just those two, what we call our comforted indexes, are saying don't be fully invested in this one. But each of the rallies that we've had over the last 2 years, we amusingly wrote that you get a 5% rally in gold, and then the gold bugs come out and say that gold's going to go to 5,000. And if you get a 20% rally in gold, then they say it's going to go to 10,000. But it's not working out. That form of style of research on precious metals is something that was learned in the 70s. The Federal Reserve was bad, and you bought gold and you made money because the dollar went down. And it did not accommodate what happens to gold when the speculation ends up in financial assets. And this is what has happened, is that the Fed is even more reckless than it was in the 70s. But at this time, the play is against financial assets. And then in the case of European bonds, particularly the German bond, getting down to negative yield, I think that's the equivalent of gold going to $20,000. The play is elsewhere, and the gold bucks just don't get it. But anyways, this kind of a play in the financial markets will end. Hopefully, our indicators anticipate it, and then that sets up a long bull market for gold and gold mining stocks, and it will eventually become the greatest game in town. So I'm looking forward to that, but we've got to go through the transition before we get there, Jim.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the Bank of Japan is quietly ending its quantitative easing, but they've been doing it for such a long time and so consistently that at the rate they're going, they will be the majority shareholder in Japan's 50 biggest businesses, and they are still the third largest economy in the world. What does that do to the markets, and does it really distort the value of the markets?
Oh, yeah. But by the way, that little note that you started with is that they are ending all the QE. This is straight up goods?
Yes, it is.
Oh, well, okay. Because they were first to get onto it. I remember at the time with the soaring Tokyo market, and there was all kinds of option strategies where corporations could raise money at virtually next to nothing, and they were out buying commodities, buying golf courses, all that sort of stuff. And there was, from the policymakers in Japan, I think their main policymaking group was called MITI, M-I-T-I, And they, of course, you're in a bull market, were considered the best policy-making government people in the world and in history, for example. But anyways, there was talk that the speculation was out of hand, which it was, and then, like any market, it just broke. The last trading day of 89 went down, and the first hit maybe was a 10%. And then all of a sudden you had, I remember one statement by a concerned policymaker in Tokyo, that, oh, we've got the ease margin requirements, this is too much of a drop. But then, of course, the world was everybody, players were fully margined and it had to unwind. But I don't know exactly when it started, but they then, after the contraction became severe, started applying the Keynesian stuff that you could ease money, and that would then reignite strength in the economy again, but not after you've been through a bubble and you have a long post-bubble contraction. And it's only their stock market has taken some sympathetic rallies with what's going on, say, focused in New York, but it is not to any, great new bull markets, considering the amount of ease they've been doing. So I think it's very remarkable that this idea is that they're going to quit. And also, it's, as you explain, they're going to quit because if they keep going, they're going to own the whole economy, in which case you no longer have a free economy. So it would be very good for the history of economics to see these demented central bankers quit their intrusions. And in this case, the intrusion has been a massive quantitative easing. I'd welcome it. It's good news that they really are going to quit.
Bob, thank you so much for chatting with us.
Yep, Jim. Look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HoweStreet.com radio. Find us on Twitter at HoweStreet. You can forward questions to Bob or to us to info@HoweStreet.com. By the way, you can check out our YouTube channel at Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.